When you talk about, I'm going to call them private bonds, if that's okay. Can I do that? Is that fair? Because I think the retail investors understand private stocks, private bonds, public stocks, public bonds. So private bonds, when you get to go lend to these institutions, this has become very pervasive across the industry because and bigger than it ever was 15 years ago because of changing in regs, right? And basically due to the credit crisis. Tell us just a little bit about that. I mean, the growth, is it sustainable? Is it here to stay? Do the banks eventually come back and say, hey, we want this business. It's good business. We're missing out on it.
The common wisdom is that banks just don't want to lend. And I don't think that's entirely true. I think they've always wanted to lend. And I've published on this, but I'll give you one indicator of why I think that's true. Have you heard of the Senior Loan Officer Survey published by the Federal Reserve on a quarterly basis?
Nope.
Of course not. You guys aren't credit geeks like I am. You don't wait for that to come out.
Love getting geeks on this call, on this show. This is awesome.
Well, the next one's coming out in July. Check it out. They ask a bunch of different. They survey the senior loan officers in Fed-regulated banks, and they ask a bunch of different questions. Maybe they're asking about AI and SaaS now, but they always ask one question, at least one question, which is: are you tightening credit standards or are you loosening credit standards? And they take a survey, and anything above zero, they're tightening credit standards. Anything below zero, and you can get this on the Fed website too. Anything below zero, they're lowering credit standards. Now, if you want to not lend, you're going to tighten credit standards, right?
Yeah.
If you do want to lend, you're going to loosen credit standards, right? If you look at the loan officer survey, you just get it up on Fred, the longest sustained period of loosening credit standards in federally regulated banks in the history of this survey started in 2010 and ran until COVID, during the rise of private credit. So I think that private credit has grown so much because it's a much more elegant and workable solution, first in direct lending, which tends to finance private equity LBOs. That's really the locomotive that at the head of the private credit train. That's where all the big allocations came in first. And I think the reason why that is before the invention of what is now known as the unitranche, to do an LBO, you have to call up PNC Bank or Comerica Bank or any regular bank, and then you have to call up a mezzanine fund, and then you have to get the two of those parties to talk to each other. What private credit figured out was that they could take down the whole tranche. They could do the whole thing, what the banks would do and what the mezz lenders would do. And that's an infinitely easier negotiation with a private equity sponsor. And once that happened, the train started to accelerate. And banks can't compete with that because they can't lend as much. They still want exposure to corporate borrowers. And if you look at the ratio of corporate and industrial loans to GDP going back 30 years, it's oscillated in a tight corridor of 8 to 10%. 8% of GDP after recession, then it goes up to 10% when the recession hits, capital rationing kicks in, and they stop lending. So I think banks have always had an appetite to lend. They just haven't had an appetite to lend. They're constrained to lend the way direct lenders lend. And so it's very much the same playbook in terms of managing the assets, being on top of your borrowers, getting your quarterly, monthly reporting. You have better transparency as a direct lender than you do probably as a bondholder, because you're only getting quarterly reports that are filed by the SEC under SEC regulations every quarter.
So you're saying that the credit is mostly used for a private equity company. So I'm going to go in and buy SpaceX. Be a big purchase, but let's say it's private. SpaceX is not public yet, and I'm going to go buy SpaceX because I'm a private equity company and I like that business, but I'm going to need capital to buy that business. So I'm going to go to private bonds or private credit to get that from somebody like Stepstone or Carlyle or Cliffwater or whoever.
That's right. And the only difference is that, and again, I don't want to conflate private credit and direct lending. LBO financings are the biggest part of direct lending, which is but one room in the private credit mansion.
Yeah.
There's private credit extends to, as I said, aircraft leasing, equipment leasing, residential mortgages, all kinds of stuff.
Yeah. When we talk about the distinction of asset backed lending, that gets into the aircraft or the mortgage or something that there's literally an asset there to help back up the loan. Where if I'm in a leveraged buyout, or which basically means borrowing money to buy a company, there's the asset, I guess, is the company. Would you call that asset backed too?
So technically, you would have if you were a skilled direct lender and
Yeah.
you had good documents, you would have all the assets of the company. If the company is a forging business in Indiana, you would have a lien on all of the property, plant, and equipment. You'd have the building if they owned it. You would have the machinery. You'd have the equipment, the stampers. You'd have the furnaces. That would all be your lien. If it's a business services company, if it's an RIA or a wealth advisor, you wouldn't have as many assets. You would have a stock pledge, which would enable you, in the event of a default, to actually take ownership of the company, to foreclose. So there's always an asset, but it's deemed less of an asset-based strategy, because in true asset-based finance, you either own the asset outright, like an airplane, where you don't have to, it's yours. If there's a default, you can take it back. You actually get, airplane lessors actually get paid in bankruptcy when general creditors don't, under a term known as the assumption or rejection of leases under the bankruptcy code.